Okay, let's dive right in. Welcome to this explainer where we're going to explore exactly how to analyze a company's financial health. We're going to bridge Ray Dalio's massive, big-picture macroeconomic machine with the nitty-gritty, microscopic accounting tools you actually need to act as a financial detective. Because, let's be real, looking at numbers in a vacuum, it just doesn't work. You've got to put those numbers into the context of the wider world.
So, we're kicking off our investigation with a pretty crucial mystery. It's one that every single investor eventually faces. How can you actually tell if a business is fundamentally healthy? And I don't just mean looking okay on paper. I mean genuinely built to survive a wild, volatile global economy and the massive tectonic shifts of a changing world order. It's definitely not just about what a company did last quarter, it's about whether its foundation is rock solid enough to withstand whatever's coming next.
To solve this, we're going to follow a really clear roadmap. First up, the macroeconomic context. Second, 3 essential financial statements. Third, decoding with financial ratios. Fourth, trend and common size. And fifth, surviving the economic cycle. All right, Section 1, the macroeconomic context. Understanding the big picture. You see, we have to grasp the macroeconomic environment first. As legendary investor Ray Dalio points out, human nature basically creates these massive debt cycles that govern every company's ultimate fate. Every business, no matter how great, operates within inescapable phases: the trough, expansion, the peak, and finally, recession. So a company's survival depends heavily on exactly where we are on that timeline. Now, there's a really critical difference in the types of risks a company faces. On one hand, you have unsystematic risks. These are company-specific issues, like, say, a terrible management team. You can build a diversified portfolio to protect yourself against those, but you absolutely cannot easily hide from systematic risk. Those are the market-wide storms, inflation, wars, or a completely changing world order. Precise financial analysis, that's going to be your best defensive shield against both. Moving on to Section 2, 3 essential financial statements, gathering the raw evidence. Zooming into the micro level here, we need to get our hands dirty and gather our raw evidence. I want you to think of these 3 mandatory statements as a company's medical chart. The statement of profit or loss, that tracks their operational success. The statement of financial position takes a snapshot of their overall health. And the cash flow forecast, well, that monitors the lifeblood, the actual raw cash moving in and out of the business. Let's take a closer look at that second one. The statement of financial position, which you probably know as the balance sheet, is absolutely vital. It tallies up current and non-current assets against all liabilities to reveal the true baseline equity of the company at that exact moment in time. It literally proves that a company's net assets always equal its total assets minus total liabilities. This right here is the bedrock of your investigation.
Section 3, decoding with financial ratios, the detective's magnifying glass.
Okay, with our raw evidence gathered, we're going to apply our magnifying glass financial ratios. This is so you don't just get completely lost in endless rows of raw data. We use 4 key categories here: profitability to check returns, liquidity to make sure they can survive sudden short-term shocks, activity to see exactly how efficiently they turn over their inventory, and debt leverage to see just how dangerously they might be relying on borrowed money. Let's look at a real-world example from our source material using Tesla's income statement. We want to calculate their gross profit margin. It's simple. Step 1, find total revenues. Step 2, subtract the cost of goods sold. Basically, what it actually costs to physically make the cars. And step 3, divide that resulting number right back by the total revenues.
Doing this specific math reveals a gross profit margin of roughly 25.5% for Tesla at the time of the report. But, and this is absolutely crucial, this clue is most valuable when you strictly compare it against other companies operating in the exact same automotive industry. I mean, a 25% margin might be terrible for a software company, but it is phenomenal for heavy manufacturing. Context is literally everything here.
Section 4, trend and common size, spotting the hidden patterns.
Here's the thing. A single snapshot in time just isn't enough to solve our mystery. Honestly, 1 year of data can completely lie to you. That's why horizontal analysis, also known as trend analysis, requires us to compare financial benchmarks year over year. By lining up, say, 2018, 2019, and 2020 side by side, it exposes whether a company's sales and profits are consistently growing or if they're secretly shrinking right beneath the surface.
Meanwhile, we use a common size analysis to normalize all this data. What it does is convert raw dollar amounts into percentages. So we set a figure like total assets to 100%. Then we can super easily weigh the proportion of every single other item. In this example, cash sits at 15% and inventory makes up a massive 60% of the pie.
So what's the big takeaway? This vertical analysis is a brilliant tool because it instantly, and I mean instantly, exposes structural vulnerabilities. By seeing everything as a percentage, it highlights if a business is dangerously tying up its wealth in illiquid inventory instead of holding the actual hard cash needed to survive a sudden recession. It cuts right through the noise of those huge, intimidating dollar signs.
Section 5. Surviving the Economic Cycle, where macro meets micro. Finally, we have to connect our microfinancial toolkit back to the macro reality. We need to determine if this company can truly survive Dalio's shifting economic phases. And what's super fascinating here is that a highly resilient company actually mirrors the exact metrics of a rising global empire. Surviving the macro machine requires a really strong balance of trade competitiveness, relentless innovation, and solid capital market backing to weather the inevitable bursting of financial bubbles.
Knowing how to analyze a balance sheet is absolutely crucial during these massive macro shifts. Why? Well, because when central banks inevitably print money to relieve a massive debt crisis, the currency devalues. As Ray Dalio points out, the value of paper money falls and asset prices artificially rise. You have to ensure your investments hold actual productive value. We're talking real assets, real cash flow, rather than just relying on inflated paper numbers.
Furthermore, integrating ESG factors into your analysis isn't just about ethics anymore. It's literally about survival. By looking at a company's environmental, social, and governance framework, you ensure the company's actively mitigating long-term systemic risks. Are they actually adapting to new carbon regulations? Are they retaining socially conscious consumers? This kind of resilience is critical in our dynamic, fast-shifting modern market.
Ultimately, whether you're analyzing the rise of a 500-year empire or just looking at the quarterly financials of a single tech business, survival boils down to Ray Dalio's incredibly simple yet profound rule. You must earn more than you spend and treat each other well. It really is the ultimate formula for longevity.
So now you possess the Focus Detective's toolkit, from understanding massive systemic macro risks to calculating net margins and spotting structural decay. But here's the real question. When the next phase of the world order shifts, will your investments hold actual, resilient value, or will they turn out to be just inflated paper illusions? Take these tools, dive into the financial statements, and uncover the truth for yourself. Thanks for joining me on this explainer.